What does the future hold for interest rates? The Federal Reserve might have some answers. Let's delve into the outcome of the Federal Reserve's September meeting. The minutes of this pivotal gathering revealed a consensus among policymakers. Most agreed that one more rate hike would be appropriate to combat inflation that exceeds the 2% target. However, the consensus was not unanimous. Some policymakers felt no further hikes would be needed. Since that meeting, there's been a marked shift in the Fed's stance. A sense of caution has emerged regarding additional rate increases. This shift is largely due to the sharp rise in Treasury yields, which could potentially impact growth. The focus has now started to pivot, moving away from whether rates should increase. Instead, the question is, how long should rates remain at these restrictive levels? The pace of inflation will play a significant role in influencing this decision. If inflation continues to rise rapidly, we may see rates remaining high for a longer period. But what about the future? Well, there seems to be a general expectation of rate cuts in the next year. However, don't expect the Fed's quantitative tightening program to pack up and leave anytime soon. Even after the anticipated rate reductions, this program may very well persist. Interestingly, the recent rise in rates could actually help tighten financial conditions, a silver lining to the cloud of high interest rates. In summary, the Federal Reserve's stand on future rate hikes seems to be a cautious one. They are keeping a watchful eye on inflation and potential growth impacts. The consensus for one more rate hike is tempered by a shift towards caution due to rising Treasury yields and potential growth impacts. So as we look to the future, it seems that the Fed is poised for a delicate balancing act. It's a challenge to maintain economic stability while also keeping inflation in check. But if anyone is up to the task, it's the Federal Reserve. The Fed's stand on future rate hikes seems to be a cautious one, with an eye on inflation and potential growth impacts. Wall Street appears to have breathed a sigh of relief following the Federal Reserve's cautious stance on future rate hikes. That's right, the market closed on a high note after the Fed's September minutes signaled caution regarding future rate hikes. Uncertainties in the economy, fluctuating oil prices, and the unpredictable financial markets led to careful policy considerations. The market did experience its fair share of volatility. However, the minutes from the Federal Reserve's meeting reassured investors about potential over-tightening and the likelihood of no further rate hikes. The consumer price index readings for September are on everyone's radar as the Fed remains data-dependent. It's worth noting that US producer prices showed a more than expected increase in September, driven primarily by higher energy costs. Now let's talk about numbers. The Dow Jones Industrial Average rose by a modest 0.19%, while the S&P 500 made a slightly better gain of 0.43%. The tech-heavy Nasdaq Composite outdid them both by increasing 0.71%. However, it wasn't all sunshine and roses. The energy sector took a hit due to Exxon Mobil's hefty purchase of Pioneer Natural Resources. On the other hand, rate-sensitive sectors such as real estate and utilities made gains as Treasury yields fell. Interestingly, the Middle East conflict led to safe haven flows, causing lower Treasury yields. Among individual stocks, pharmaceutical giant Eli Lilly gained 4.5%, thanks to Novo Nordisk's success with Ozempic in a kidney failure trial. However, healthcare companies DaVita and Baxter International didn't fare as well. The market breadth favored advancing issues on the New York Stock Exchange, with decliners having a slight edge on Nasdaq. The S&P 500 recorded new highs and lows, while the Nasdaq Composite had a considerable number of new lows. Trading volume, however, was slightly lower than the 20-session average. In summary, Wall Street's reaction to the Federal Reserve's cautious stance on future rate hikes was generally positive. The market closed higher, with most sectors showing gains. However, uncertainties remain, such as the impact of oil prices and the ongoing conflict in the Middle East. While the market experienced some volatility, the Fed's reassurance about potential over-tightening and the likelihood of no further rate hikes seemed to have steadied the ship. And with that, we wrap up our discussion on Wall Street's reaction to the Federal Reserve's stand. Stay tuned for the next scene, where we delve into the impact on oil prices. The oil market also reacted to the global economic scenario. Let's delve deeper into that. Oil prices took a hit, dropping more than 2%. This drop was primarily due to Saudi Arabia's commitment to stabilize the market. easing concerns about potential Middle East supply disruptions. However, the oil market is not immune to international tensions. Fears of an escalation in the Israel-Hamas conflict had previously pushed prices to surge. Trading houses like Mercuria even warned of prices reaching a staggering $100 a barrel if Middle East tensions worsened. But it wasn't just geopolitical tensions weaving the narrative for oil prices. The ever-watchful eye of investors was keenly fixed on the Federal Reserve's meeting minutes. These minutes provide valuable insights on future interest rate decisions, which can significantly impact oil demand. A rise in interest rates can lead to a decrease in oil consumption as it becomes more expensive for countries to borrow money to purchase oil. The uncertainties surrounding the US economy also played a part in influencing oil prices. The US Energy Information Administration report predicted a global oil inventory decrease, adding another layer to the complex tapestry of factors affecting oil prices. One of the noteworthy developments in the oil sector was Exxon Mobil's agreement to acquire Pioneer Natural Resources in a massive $59.5 billion all-stock deal. This deal catapults Exxon Mobil to the position of the largest producer in the Permian Basin, a prime oil and gas producing region in the US. This acquisition not only shakes up the industry hierarchy, but also potentially impacts production levels and ultimately oil prices. In conclusion, the oil market is a dynamic entity responsive to a myriad of influences, ranging from geopolitical tensions and economic uncertainties to industry developments. Oil prices, it seems, are subject to a complex interplay of factors, from geopolitical tensions to economic uncertainties. So, what lies ahead for the global economy and financial markets? The landscape of the global economy is ever evolving, and as we move forward, there are several key factors that could significantly impact its trajectory. One such factor is the upcoming Consumer Price Index, or CPI, readings for September. These readings are crucial as they provide an indication of the inflation rate, which in turn influences the Federal Reserve's decisions on interest rates. The Fed's policy remains data-dependent, meaning any significant changes in these readings could potentially sway their future stance on rate hikes. The Federal Reserve's quantitative tightening program is another aspect to keep an eye on. While rate cuts are anticipated next year, it's likely that this program may continue even after these reductions. The recent rise in interest rates could potentially aid in tightening financial conditions, a move that could have a ripple effect across various sectors of the global economy. Geopolitical tensions also remain a significant factor that could influence the global economy and financial markets. Recent developments in the Middle East and the subsequent fluctuations in oil prices serve as a stark reminder of this. As we've seen, the commitment from Saudi Arabia to stabilize the market has led to a drop in oil prices, but any escalation in tensions could potentially push these prices back up. Inflation, too, remains a key influencer. The pace at which inflation continues to rise will undoubtedly impact the decisions made by policymakers worldwide. As we've seen from the Federal Reserve's September meeting minutes, combating inflation above the 2% target has been a significant focus, and this is likely to continue to be a priority moving forward. Rate hikes are another factor that could shape the future of the global economy. While most Fed members have backed future rate hikes, there's been a shift towards caution regarding additional increases. This is primarily due to the sharp rise in Treasury yields and potential impacts on growth. The focus now is shifting towards determining how long rates should remain at restrictive levels, a decision that will be greatly influenced by the pace of inflation. Finally, oil prices remain a crucial element. As we've seen, fluctuations in oil prices can have a significant impact on the global economy. With tensions in the Middle East and changes in demand for oil, the future of oil prices remains uncertain. As we can see, a multitude of factors could sway the global economy and financial markets. The interplay between these elements, the CPI readings, the Fed's quantitative tightening program, geopolitical tensions, inflation, rate hikes, and oil prices will continue to shape the future economic landscape. The global economy and financial markets are at a critical juncture, with various factors poised to influence their trajectory. Only time will tell what the future holds.